Politicians, by law, are required to disclose all of their stock holdings and any movements within their own portfolio. Today, we have access to every single one of these politicians, what movements they've made just over the last few weeks, and we're going to talk about the top 8 most sports stocks by these essential politicians just over the last few weeks. Now, in detail, we do have their movements, what they've bought, what they've sold, the date they've placed the trade, and when the information has been published. However, today we are going to condense it and go straight into those 8 stocks that have been bought. Yesterday, in detail, we did run through Nancy Pelosi's trade, so do check that out if you're interested. Although at a very high level, the first one that we will talk about is Nvidia, which, as we saw just yesterday, Nancy Pelosi has bought more shares. Now, bear in mind, this is a company that is up 202% over the last 12 months. Over the last 10 years, absolutely phenomenal, up just under 27,000%. And even with this rise, we still note that Wall Street do indicate Nvidia is a strong buy now, even with its forward P sitting at 47.33. Now, as always, we have run into the analysis of this company, and it did come to our intrinsic value of $140. Now, how we arrived at this, essentially we put Nvidia through the DCF model. We got the free cash flow year on year, and we can clearly see an average growth rate of 95% year on year. We then used 3 different rates, a low, medium, and high. Forwards looking though, we did go for the medium rate of 30%, essentially saying that over the longer term, we see free cash flows growing at that level. With the discount rate, we then got the present value of those future free cash flows and terminal value, which we add to the cash, subtract to total debt, arrive at the equity value, divide by those shares outstanding, and we got to that value of $140. Now, as always, people may say that value is way too low. The growth rate should be a lot higher given the boom in the AI industry, estimated around 40% year-on-year growth. So for those that do believe this to be high at around 40%, you can clearly see the intrinsic value would be more than double that current trading price. As always though, you can grab a copy of this model, put your own numbers through to get your own intrinsic value and upside as well. Forwards looking though, we are going to take that medium rate for Nvidia, which is the first stock we are looking at today. As we said, an intrinsic value of $140. With that current price of $128, the margin of safety that we always start off with is 10%, and we advise that we would execute on that if we believed it met the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Therefore, we can see that today's value, it isn't too far off that 10% MOS level, and clearly Wall Street do see a lot of upside. They did indicate this as a strong buy now, as we just saw, and their price target over the next year is $158, 24% to be gained over the period. The next stock politicians have been buying is the Home Depot. Now, we do get 1 buy rating, although it is from Wall Street with a double hold from the others. It does have a forward yield of 2.7% and a forward P just under 22, in fact not far off the S&P itself, and we note it is in the midpoint of the 52-week range. In terms of its performance, well, over the last 12 months, it is up around 8%. Over the last 10 years, if you have been a shareholder, very decent performance, up 321%, and you would have outperformed the S&P 500 during this period. In terms of our intrinsic value, well, we arrived at $385. With the current price at $333, we see that margin of safety of 10% does lead to a buy at around $347. And as always, we keep going till it is near that current trading price. Not at a 15% MOS level today, somewhere sitting between a 10 to 15%. And in terms of Wall Street, their essential price target isn't that far off our intrinsic value, $383, with upside from what they believe 15% over the next year. The next stock is ASML Holdings, so another semiconductor company. We get a double buy rating with the hold coming from Quant. It is trading again similarly to Nvidia, right there towards its 52-week highs. Again, a forward yield, although very marginal at 0.7%, and a forward P that surprisingly is higher than Nvidia, sitting at just above 52. In terms of the performance, well, 46% over the last 12 months. Over the last 10 years, very, very strong, up over 1,000%. Bear in mind, this doesn't include dividends reinvested, so it would be up marginally higher than that point. In terms of the valuation, well, we do get to a value of just over $1,000 based on these 2 models that you can clearly see. With the current price then, essentially what we are saying is that ASML in today's market is trading not far off its current value, but if you had to say, it is trading at a very marginal premium. However, there will be those that will want to see the margin of safety at 10%, and that would indicate a buy at $914. At 15%, this would be around $863. As we said though, today's episode there is no MOS. And in terms of Wall Street, they do see upside, although they do believe it is fairly marginal at 3% over the next year. Now, before we move on to the next stock, just to let you know, for those that are subscribed to the weekly newsletter, we are releasing our 49 Dividend Kings, where we run through every single one. We're going to talk about the upside and the undervaluation, so if you want to grab a copy, make sure you are subscribed. And as always, that does give you free and instant access to all of these articles, as well as the spreadsheet. You can click on the pinned comment below and start reading. So the next stock is Costco Wholesale Corporation, where we have one buy from Wall Street, a double hold, and again, very similar, trading at its all-time high. In terms of the forward yield, well, 0.54%. Forward P, in fact, even higher, sitting at just below 54. Over the last year, incredible performance, up 63%. Over the last 10 years, again, significantly outperforming the S&P, up 722%. When we get to the valuation of Costco, well, no surprises, we do see this as essentially overvalued. We believe the intrinsic value around $718, and we can see that current price does mean that if we were looking at a 10% margin of safety, we would have to wait around $647. In terms of Wall Street, they also believe there is no upside. They see negative 1% downside, with their price target $854 over the next 12 months. Now, bear in mind for Costco, where we are getting our valuation from, again, is just that DCF model, where we do have our three rates, low, medium, and high. We did ultimately go for 15%. Now, those who do believe it should be much higher, at 20%, that would indicate a price around $1,000, and that would give you an upside of 17%. However, as we did say, with our medium rate, we do see this as overvalued and trading right now at a significant premium. The next company is Chipotle Mexican Grill, which recently had a stock split. We get a buy rating from Wall Street, a hold from the other two analysts, and it is trading towards its 52-week highs. This doesn't pay a dividend just yet, and we do see forward P very high at 55. Over the last 12 months though, up 45%. Over the last 10 years, again, very strong performance, 414, and another one to add to that list of those that have outperformed the S&P. Well, in terms of our intrinsic value, we get to $58, so very similar to some of these companies. We do believe they are trading at a premium. If you are looking for a MOS level of 10%, well, you would have to wait for around $52. And we can see in terms of Wall Street and their forecast, $67. They do see upside, but it is fairly marginal at that 8% level. The next one, we have Crowdstrike Holdings. In fact, we have a strong buy from Wall Street, although a double hold from the other two analysts. Again, trading at its 52-week high, a forward P that does look very, very high at 96. Over the last 12 months, well, it is up triple digits. Over the last 5 years, we can see up 476%. When we talk about this company and we do look at that model, we get a price of around $380. Now, bear in mind, as the current price is higher, this is another one that we talk about being trading at a premium, overvalued. And Wall Street, whilst they do see upside, their price target of $400 does talk about very minimal, low single digit. We then move on to Lululemon Athletica, where we get a double buy rating, a hold from Quant. In fact, the first one that we see trading at its 52-week low with a forward yield of 21, marginally lower than the S&P, down 21% over the last 12 months, and over the last 10 years up 647%, although we can see it is some way away from all-time highs of around $511. When we look at the valuation of this company, well, $410 on the DCF model, current price at $300, a large MOS level. Before we look into this, again, the DCF model, what we've done here, low, medium, and high, instead of using the medium rate of 20%, we've pretty much got it in line with the 10-year average of 19%. And we can see, though, if you were looking at other rates, for example, you believe this will grow at 25% over the foreseeable future, that does imply some very large upside. However, moving on to the intrinsic value itself, our margin of safety of 10% does give a buy at $370. At 15%, around $348, and at 20%, again, still showing that Lululemon, based on these estimates, does have a very large MOS, not at 30% yet, but sitting somewhere between that 25 to 30% level, with Wall Street themselves giving this some very large upside 37% price target of $410. And as always, do let us know your thoughts about these stocks as we do go through. We then finally move on to Nestle, where we do have one buy rating from Wall Street, a double hold, and again this is trading similarly towards its 52-week lows with a yield of 3.2% and a forward PE of just under 19. Over the last year, not the greatest performance, down negative 15%. Over the last 10 years, it is up, although not great, plus 33%, underperforming the S&P and barely keeping up in line with inflation. In terms of the valuation, well, the value we get to is $122. So we would expect a decent margin of safety. At 10%, we'll buy at $110. At 15%, pretty much on that current trading price. So will depend on what you want in terms of your strategy. And at 20%, well, just under $100. So in today's episode, you're looking at a 15% MOS level, upside around 17%, price target $120. Again, not dissimilar from our intrinsic value. As always, let us know your thoughts in the comments below. Are you adding to any of these 8 stocks like the politicians? Are there some that are on your watch list? Or maybe for whatever reason, they aren't ones you're considering to add. As always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.